Yes, good morning. Good morning, everyone, and thank you for joining us this morning, distinguished participants. We thank you so much because on mornings like this, we know that there's a lot going on, but for sparing the time to come and join such an important, in our view, webinar, it shows that you're interested in the retirement benefit sector. Your moderator this morning, I am Benjamin Muchibi. I'm the head of research and strategy at UBRA, and I'm really interested in this topic as well, and I'm glad to be here. I see that we have already 35 participants online, and indeed, in such a challenging fiscal climate, we note that revenue mobilization is at the top of agenda of government. Yet we are also concerned about domestic savings mobilization. Or in the context of this webinar, may I say saving and investing for retirement is something of concern when we look at it as a driver of making sure that those who save enough for retirement. So taxation is at the heart of the inclusive growth debate, where we don't leave anyone behind, but especially during the time when you expect certain levels of vulnerability. So taxes are known to affect employment and investment, and are indeed found to have important implications for the economic growth of the country, as measured, say, by the GDP. Yet taxes are also known to affect much broader aspects of social welfare. So indeed, if our focus this morning is to look at the social welfare aspects, the objective of the social welfare is to ensure that those who are vulnerable are taken care of. But we cannot continue thinking that government will always chip in by mobilizing revenue. Rather, we're looking at mobilizing savings when you look at the context of the retirement benefit sector. So social welfare is encompassing to cover not only occupation and personal pensions, but also basic provision that I talked about with regard to government revenues, like the cash transfers that we speak of and the social pensions. But we are looking at the tax treatment in the retirement benefit sector as, on one hand, an avenue to mobilize domestic savings, but most importantly, to ensure that those who save enough to deal with the contingencies of old age. So we're really glad this morning to discuss. Our agenda, as was shared, is tax implications for retirement benefit schemes in Uganda. And at this point, I would like to welcome the Chief Executive Officer of the authority, Mrs. Rita Nansasi Waswa, now to give us the opening remarks, which will set a stage for further discussions on this important matter. Madam, you're welcome.
Thank you, moderator, Mr. Benjamin Muchibi, and the participants on this call. Good morning, ladies and gentlemen. Kindly confirm that you can hear me.
Yes, we can hear you.
Thank you. Good morning, ladies and gentlemen on this call. Thank you for sparing time to attend this webinar. I welcome you most sincerely on behalf of the board, management, and staff of UBRA. Ladies and gentlemen, whenever you hear the word taxation being mentioned, everyone gets on high alert, wondering what's coming next. They wonder whether government is about to impose a new tax. But for this webinar, please take heart. It's not about any new tax being imposed, but it's to enable us appreciate the taxes that are applicable in our sector and how they impact us as individual savers in the various schemes. Like any other sector operating in this economy, taxation is a reality for the retirement benefit schemes, for the retirement benefit sector. And often there are discussions in the public domain concerning taxation of retirement benefit schemes, taxation of terminal benefits, pension, gratuity, and any other service awards. For example, in Parliament during the debate on the NSSF Act, there was a heated discussion on taxation of benefits at the payout phase, but this was dealt with by the rationale that was in support of not taxing savings on the payout phase. And this webinar will help us appreciate this and better understand any other taxes that are applicable in this sector. You could also be aware of several other cases that we've been reading about where the tax authority, that's the URA, has been involved either with individuals or retirement benefit schemes, touching the matter of taxation of their benefits. These cases have been decided in different ways on a case-by-case basis. We also heard about the case of NSSF versus URA, where URA wanted to tax the interest declared by the fund to members. This was handled from the Tax Appeals Tribunal up to the Commercial Court, and thankfully it was decided in the favor of NSSF, where the Commercial Court upheld the fact that members' interest should not be taxed. We've also had similar scenarios with the Bank of Uganda retirement benefit scheme, still touching the matter of taxing members' benefits. And in this case, the Tax Appeals Tribunal ruled in the favor of Bank of Uganda. Ladies and gentlemen, there are several concerns in the sector regarding taxation of retirement benefits. As such, that's why OBRA deemed it worthy to have this webinar to help us discuss the matter of taxation and better appreciate the applicable taxes and their impact on our savings. Thank you for logging on, and I wish us fruitful deliberations. Thank you so much. I hand back to the moderator. Thank you.
Thank you so much, Madam, for the remarks. You have set the stage for us to dip into our agenda this morning. Distinguished participants, I encourage you to participate in our pre-webinar poll. We shall also have a post-webinar poll. These polls help us to do better, to collect data, to understand your interests, and then as we plan for subsequent webinars, we are able now to meet your interest better, or anything that you want us to focus on can be captured from this kind of polls. Next week, on the 25th, we expect to have another webinar, which will be on member rights and obligations. We also encourage you to take an interest in it, because at member level, you need to know what really matters for you as a member and the obligations of the parties that you interact with, whether it's the trustees or service providers. You need to know, and it matters for you because then you do better as a member as it relates to your savings for the future. This morning, distinguished participants, we are going to discuss the matter of tax and the retirement benefit sector. And a number of questions are raised about about this matter, especially from the point of view of savers. For instance, why should we have to pay tax when we have the foresight to put aside money for our retirement? Now, this is a question that comes forward, especially when we know for sure that we are avoiding the burden that we may bring upon society and to government. So, at the end of the day, members continue to ask, aren't we taxed enough in other areas? So, if these questions are not answered, members continue to wonder. They even ask, but why do scheme members have to pay tax on their income? So, understanding the retirement benefit sector and the tax that relates to it is important. Indeed, it matters because it affects members' well-being in retirement. So I'm glad this morning we have our main discussant. It's Mr. Cosma Senyonga. Cosma Senyonga is an accountant. Most importantly, he's a member of staff of the authority. He's our manager, Prudential Supervision. Cosmas has been involved in a number of studies across the region and in the country on matters taxation and retirement benefits. So he has a solid understanding of what it means for a member from all the stages, from the time when one starts contributing, that's when we look at the part of the income that is saved, through to when investment earnings come in, the capital gains, and till the time when the benefits are paid. So we are glad to have him this morning. I was our main discussant. So please allow me to invite Mr. Cosmas Senyonga at this moment to make the main presentation. I believe this presentation is going to be engaging. The opportunities for us to interact where we can put across questions that will be considered as we go along. And I believe that we shall not remain the same in as far as understanding tax matters as they relate to the retirement benefits sector in Uganda. So Mr. Senyonga, you are welcome to make the main presentation.
Thank you, Benjamin, and good morning, ladies and gentlemen on the call. Cosmas Senyonga is my name, and as Benjamin said, I'm working with UBRA, Retirement Benefits Regulatory Authority. And I think I've been in this sector for more than 10 or close to 10 years. So I'm glad that I'm going to be sharing with you on this important subject matter, where we're going to appreciate some of the tax policies which are very pertinent to the retirement benefit sector. And also we'll draw some kind of comparatives. So in terms of the regional perspective, what's happening elsewhere. We also look at some of those key policy aspects, which are very important when it comes to taxation in our retirement benefit sector in Uganda. But the issue of taxation is usually a bit complex, and being complex, that's why sometimes when people talk about taxation, tax, they tend to be boring. But at the same time, people tend to try to be skeptical on what it means to them. Probably they're planning to introduce a new tax. What are they trying to say? You get. So it is a complex subject, but very interesting, because at the end of the day, we need to support our governments in terms of providing what we need as best needs for the citizens of Uganda. So we've seen that over the years, and especially in the recent years, the number of reforms which are happening across the globe. But interestingly, they are not focusing on trying to enhance or improve on their legal framework. Focus is more on to what can we do beyond the legal framework to develop, to grow our retirement benefit sector, such that at the end of the day, the citizens can have that decent kind of standard of living during their retirement. So governments across the globe have started thinking about how best can we improve the social well-being of our country, or of our citizens, in terms of trying to look into a number of policy issues, of course, including taxation. But the big challenge some of these countries are facing is how can we balance between the primary objective of these retirement structures or arrangement and the secondary objective. Primary objective is basically how can we enable these members or the citizens to be able not to face issues of old age poverty? How can we alleviate old age poverty? At the same time, how can we help our governments in terms of mobilizing domestic savings? So most of the countries which are being run on a deficit budget, cost priority is always going to be revenue, domestic revenue mobilization. And once they focus there, they tend to be myopic when it comes to looking into other key policy issues, including long-term savings. So countries have indeed leveraged on policy issues when it comes to retirement system, and they have been able to try and focus on the 5 major outcomes. And these are the sustainability, coverage, adequacy, efficiency, and security. But when it comes to tax policies, you will see that countries which indeed want to improve the sustainability of their retirement systems, they are basically giving some kind of tax reliefs to employers in terms of either reducing on their marginal tax rates to support them to be able to sustain, to contribute into these retirement arrangements. At the same time, giving them some kind of deductions. If you contribute a certain amount into retirement benefit scheme as an entity, as a corporate entity, then when it comes to determining your taxable income at the end of the day or the year as a corporate entity, we are going to give you a deduction which is an equivalent to what you've contributed in the pension schemes. So we've seen that happening in the number of countries when it comes to enhancing the sustainability of these arrangement. But we've also seen, especially when there is a transition from this unfunded pension scheme, like how you say our public service pension scheme, if they are to transit into a contributor arrangement, they are normally an introduction of some kind of support system. We saw that happening in some of the countries in the South African side, where there was that trend of moving from DB to DC, and they could introduce some provisions into their legal frameworks, their laws, where they try to not to tax these new arrangements to enable them accumulate the required assets to meet the obligations. So all that has been happening across the globe, where tax policies are very critical when it comes to improving sustainability. But again, on coverage, you've seen this happening. And this is now, in fact, very common across Africa and Asian countries. When you look at the India, the Indonesia, their support systems in terms of tax reliefs to the participants. So you give a tax relief in terms of allowing a contribution. If I make a contribution from my salary to a pension scheme, then when they are determining pay as you earn or what I should pay to you, it is a net of that amount. So those kind of tax reliefs support when it comes to increasing coverage in these sectors. And we've seen that happening a lot. And even the studies indicate that that if you're to increase coverage, especially in the informal sector, there is need to look into tax incentives, reliefs from the government if you're to succeed, if you're to bring that cohort on board in terms of continuously contributing into these arrangements. Then the adequacy. Again, if you want to improve the adequacy, members' benefits at the end of the day, because we are talking about a tax which is likely to reduce on the overall returns at the end of the day. So some reliefs will enable these funds to grow in terms of, in terms of their asset base. So having a return, a relief on a return, individual members' accounts will grow because there will be higher interest distributed to these members. And we've also seen that has also been used, tax policies, they have also been used when it comes to preservations. So I remember when we had a discussion of midterm access here, people indeed wanted to access. But what we failed to do is to have a clear separation between accessing for a social purpose and also accessing to meet other obligations. So in some countries, and I think in the recent reforms in South Africa, where they have introduced a two-pot system of a long-term and a saving arrangement. The saving arrangement, if you're in South Africa and your money is under that arrangement, you see that there is a higher marginal tax rate compared to what's on the side of a long term. So they are trying to ensure that they preserve the monies which you've contributed, such that they are indeed available and they are adequate when you're into your late hours. So with midterm, the early access, there is always a penalty that if you receive your money prior to retirement, then you should pay a certain tax. So there are always those balances. And when these issues are being discussed or they are going to be adopted, all those issues should be taken into consideration. But starting from, why are we having this kind of arrangement? Is it for people to enjoy even before they retire or before or even after? So we've also seen double taxation agreement, and this is majorly when it comes to social security, there are majorly agreements between countries to enable portability. So if I've accumulated money probably in Kenya and I transfer it in Uganda, it shouldn't be taxed. So there are a number of social security agreements across Africa. There is one between Morocco and Spain. So migrants in Spain from Morocco, when they are going back home, they are not taxed, and they are because of that kind of agreement. Rwanda and Burundi, they have a tripartite agreement, I think, with the Democratic Republic of Congo. The same agreement speaks a lot about some of these tax issues and how they can protect these accrued benefits which are being transferred from one country to another when it comes to policy issues. But let's look at the investment outlook, because this is going to inform some of the discussions later. Because as I said, you have to pay tax, probably as an individual, even as a retirement benefit scheme. But surprisingly, the money is not only invested in Uganda, and the Income Tax Act in Uganda cannot be enforced in Kenya. They have their own laws. In Tanzania, they have their own laws regarding taxation of resident and non-resident. So we are likely to have different tax rates when it comes to investment in different countries across the region. So I just wanted to show you how geographically we're concentrated as a sector. But you can see that 68% is in Uganda, of course, in different asset classes. So out of that, 79 is in government securities. So meaning that if you look at the portfolio, the income portfolio of any retirement benefit scheme in Uganda in any year, you're likely to see that close to 80% or 90% of the incomes are from that asset class. But we've also seen that 24% is in the Republic of Kenya, where we've greatly invested in government security, close to 5 trillion. Then, of course, followed by the United Republic of Tanzania, again with around 7.7%. I see a small portion in Rwanda, I think 2-3 years ago, there was a portion in Burundi, which was basically on a bond, and it matured. So right now we are concentrated in those 4 countries as at 30th June 2024, and that's the allocation. So where your money is, that's where you'll be taxed. But of course, there are a number of agreements which can also be put in place to ensure that if I'm taxed in Kenya, I'm not taxed again in Uganda. Some of the things we're going to discuss in the subsequent slides. But we can also look at the sector contribution to the tax revenue. I'm looking at the last 9 years, from 2014 to 2023. You can see that the revenues from the sector, they have been increasing. But also I have to mention that our sector is not contributing much to the tax revenue. And I'm not saying that we should, because of what I mentioned earlier. So the primary objective is not to have more revenue from retirement benefit systems. It is basically another objective of alleviating old age poverty. But we can see that there's been a positive trend, growth rate, when it comes to the tax revenues. And this is withholding tax. And you see from around 62 billion, we're around now 230 billions. This speaks a lot on where the tax applies. So withholding tax is majorly, when you look at our sectors, from the investment incomes. So you can see that we contribute a lot in terms of withholding tax when it comes to looking at how much comes from our sector. But we also have a certain element, which is a corporate tax, and it's a bit small. So you can see from 2 billion, sometime it increased to 9, and now around 4 billion. So the figure is a bit small, but the focus here is basically to appreciate that most of the taxes from the sector are here on the withholding tax. And the question will be that, is it a final tax? So majority of those incomes, withholding tax is a final, so you don't pay any other tax. So where it's not a final, that's why you have this other graph here of a marginal corporate tax revenue. So that is it in terms of the outlook on investment and tax revenues. But there are some key policy aspects for our retirement benefit sector taxation. And there are 2 key important documents here. One is the Constitution of Uganda. When you look at the Constitution of Uganda, there is an exemption provided into that document, and it relates to a pension. So if you're paying a pension as a scheme, you're exempted from charging any tax from that pension. So you see now how some of these documents, they are framing the structure of a tax regime of our country. But we also have the main document, which is the Income Tax Act, with a number of provisions relating to taxation. But of course, going back to what Benjamin said, that in some countries where they indeed appreciate the existence of this arrangement, you find that most of the laws or the provisions relating to taxation of this arrangement are totally separate, and they are always in a separate document from the Income Tax Act. When you look at the Income Tax Act, they're basically looking at mobilization of revenues. And I'm not saying that during the discussions of some of those provisions, they don't consider some of these other policy issues. They may consider them, but what I'm trying to emphasize here, that in some countries, because of the appreciation of some of these sectors, they have a totally separate tax laws or tax documents for those sectors. When you go to UK, I think they have his or her. I think now it is his, but before we used to call it Her Majesty. So it is basically looks at social security systems and some of other policy aspects. So when it comes to taxation, it's what taxation of a retirement arrangement, the focus is on that document, not any other tax laws. But I wanted to share with you some of these definitions as per these two documents, specifically the Income Tax Act. They do define what a retirement fund is. They also they define what a resident fund is. Why I'm defining them? Because we have retirement benefit schemes, but are they recognized in the laws of Uganda? The Income Tax Act is very clear on what a retirement fund is, and it should be that entity established, yeah, to provide benefits to members in the event of retirement or to dependents of a member in the event of death of a member. But it goes ahead and define who a dependent is. If you're a trustee on this call and you've been paying death benefits to dependent, I think you need to be mindful of who a dependent is when it comes to a member of a retirement benefit scheme. And it clearly defines it as a spouse of a member, a child, including the adopted child of a member who is under the age of 18. They're also introducing another or other relative of a member who the commissioner is satisfied that that dependent he has been relying for support, yeah, from the deceased. So if I have an account with a staff scheme, an occupational scheme, or a pension scheme, and I put my uncle because I know he supported me, and I put him as a beneficiary. When it comes to paying out the benefit, probably is going to be looked at as a dependent because it's not my child, and you know. So, but the question is, that person, has he been relying on me for support? So this is a very pertinent question which you need to ask yourself as a trustee when you're paying out some of these benefits to the dependents. Of course, there may be another thing. But the same Income Tax Act defines a resident retirement fund. And a resident retirement fund is the one which is established under the laws of Uganda. And probably we are looking at those which are licensed by the Uganda Retirement Benefits Regulatory Authority, operated for the purposes of providing retirement benefits to resident individuals. And of course, the management and control is exercised within the Republic of Uganda. So if you're a resident, I don't know if you have a non-resident retirement fund, but for you to benefit from the tax reliefs or from the tax benefit within the Income Tax Act, your retirement benefit scheme should be able to fit within these definitions. I've seen in some countries, in Kenya, if you're a retirement benefit scheme and you want to get the exemptions, the tax reliefs from the KRA, then you must get a certain kind of documentation from the Commissioner General. So they are required to grant, I don't know if they are putting in an application, but they write to the Commissioner General to get that kind of documentation. So without it, they cannot benefit. Here, we don't have it because of a number of reasons. Probably we don't need it because of the tax structure of our system. But where can taxation apply in a retirement benefit system? In a retirement benefit system, there are only 3 stages at which a tax or taxation could be applied. At the time when you are accumulating your retirement benefits, I mean when you're making your contribution. It can also be applied at the time of investment. So when trustees receive your money, they try to preserve it from inflation by investing. So when they invest that money, there is a return which comes into the scheme. The question is, should we tax at that stage? Or we wait until somebody is exiting and we tax his or her benefits. So across the globe, when you study, when you try to look at the literature, you'll notice that those are the only stages at which taxation can apply. No any other area where taxation can apply. So the question to the policymakers and those who determine these tax policies and laws, the question they always have is, should we tax or exempt at contribution, at investment, or at benefit? That informs the tax system of that retirement system, of that retirement sector. They are either going to decide that we are going to have a comprehensive system where we are going to tax at different stages. They can decide to tax at contribution or even tax at the time of investment. Or they may decide to tax at investment income or when somebody is exiting. So when you have two tax points within a tax retirement system, that's a comprehensive kind of tax system which is adopted by that country. But we also have what we call a consumption, an expenditure tax system, which basically don't tax at earning, but they tax at consumption. Consumption they can tax at the end when members are receiving their monies, or at the beginning when people have received their salary and they want to go and consume. So you either save or consume. So those are the two major, and that's the question which they always have. The question is, what's the best for a pension system? Yeah, so we'll know that later. But from the literature I've seen and some simulations which are done from a number of studies where I've been involved regarding taxation, even across the region, we noted that in countries with preferential treatments, when it comes to retirement benefit system, they opt for an expenditure tax system, which either tax at the beginning or tax at the end. But of course, there are other key issues which these guys consider. If you look at EET, which is in Kenya, it may not be the EET which is in South Africa. And maybe just for the members, for the benefit of this presentation, when I mention E, I mean exemption. When I mention T, I mean taxation. And this EET, I'm trying to assign them to the stages. If you see E, for example, if you see E, ET, I'm basically meaning exemption at contribution, exemption at investment, and taxation at the end. When you see TE, it is tax at contribution, tax and investment, and tax at the end. So depending on how I bring it up in this presentation, I'm just trying to assign them to a certain stage within the operation of retirement benefit system. So going back to what most of the countries, especially countries with developed retirement systems, they tend to adopt one of those two options under the expenditure approach. And you find that the number of preferential treatments which are there for the members, for the employers, when it comes to remitting contributions. But we've also seen that some other countries, they have adopted comprehensive tax system. And why they normally go for an expenditure tax system, because they look at a comprehensive tax system as a system which does not appreciate that, retirement benefit arrangement are not commercial purpose vehicles. People don't save to say, I'm putting my money there to earn a profit and exit tomorrow. No, people are into this arrangement to save for a social purpose, where even the government, they have an obligation to take care of their citizens. If you look at a certain, I think, article in our constitution, which I don't remember, there is an obligation of the government, and that's why you've seen that there are a number of support systems through cash transfers from the government of Uganda. I'm sure you know about the SAGE, where they are giving the Awamzes the 25,000. And there is also SEGOP, where the government was telling the older people, I don't know if it is 70 years and above, that please come up with some kind of group such that we can give you money and you start business. And you wonder which kind of business those mzees can do at that age, and if they really need, can think about those businesses. So that comes because our systems, we haven't put in place systems which can help government in terms of not spending, not incurring those kind of expenditure. And if you look at SAGE, in 2020, they spent around 60 to 65 billion for this social assistance program. Come 2023, the figure had significantly grown to 149 billion. And we did some simulations 2 weeks ago when we were working on a certain document. And we realized that if nothing is done, and if they are to take care of all the people, I mean those who are 60 and above, in 2050, we are likely to be spending close to $1 trillion, more than $1 trillion, close to $2 trillion in 2050, just on that one program. So we need, I think, to go back to the drawing board and to think, what can we do to ensure that the people, prepare for themselves for that time. Again, the comprehensive tax system ignores the fact that savings are a means of future consumption. So I'm saving my money and I will utilize that money probably in the next 30 years. So there is no need for it to be taxed now, because I'm not going to utilize the same amount now until I become eligible. So another one, which is, I think, very critical for us, is that in the comprehensive tax system, they tax nominal returns. And just imagine in instances where the inflation is high. So the real return will be what? It will be totally lower. And if the inflation is more than the return on investment, you're going to have a negative real return, which basically means that the members, in terms of time value for money, they are losing the value for or the purchasing power of their savings. So in all countries across the globe, these are things which they have to consider. Where should we tax? Which kind of tax system which is good for our nation? And of course, the number of other things which they do consider. Issues of the legal framework, issues of the economic factors, social factors, and the political factors. Sure, you've some years back you heard about riots in countries like France and Greece regarding social protection policies, which those two governments tried to bring on board. So in those countries where people are indeed familiar with what's happening, and they did have they really did want to know that, where my rights are protected by the government. That's why they go into those kind of strikes to ensure that their rights are protected. So I want to look at the Ugandan perspective when it comes to either comprehensive or an expenditure approach. So I'll start with the time when you're making a contribution in a retirement benefit scheme. So when you're making a contribution to a retirement benefit scheme, there is a portion which comes from the employer, and there is a portion which comes from your employment income as a member of a scheme or as an employee of a certain institution. So when you look at the Income Tax Act as it is, you will find that the contribution which you receive from the employer, the 10% which goes to NSSF, and that other rate which goes to your occupational scheme, that one, it is not taxed. So it does not form part of your employment income. So when they are preparing their payroll, it doesn't appear anywhere as an income to you. But we've seen in some countries like Rwanda, the 6% which you receive from the employer, it is included in your employment income. So when it comes to determining your pay as you earn, it is taxed. So we'll look at what's happening in some of those countries in the subsequent slides. But here in Uganda, the 10% as it is not taxed. The question is always on the employee contribution. What I contribute to NSSF, the 5% or any other arrangement. When I make my 5% to NSSF, if, for example, I'm earning 1 million, my monthly gross pay is 1 million. So you'll see that the 100 million will go to NSSF, and the 50,000 will also go to NSSF. So in some countries where they give a tax relief in terms of contribution, you find that the 50,000 is netted off the 1 million before they determine pay as you earn. You get it? So if it is not netted off, you find that the taxman or whoever is preparing the payroll, he will charge, I'm assuming a 30% tax rate for pay as you earn. He will charge a 30% on the 1 million, which will make it 300K. So look, somebody is having a disposable income of 650 because they have deducted a 50,000 and the 300 as pay as you earn. So meaning to the scheme, as I said, you will see that you have your 150,000, but you did not get a relief of this from your gross pay, to a pension scheme. So this is the arrangement we have in Uganda when it comes to taxation at the stage of contribution. So you will see that what will go to NSSF won't be less from what is being deducted from the payroll, but the effect is here on the disposable income. So countries where they have adopted 100% E, where the employer and the employee contributions are tax-free, you will see that they get a tax relief of 50,000, which is equivalent to the 5% they contribute as members, as employees to NSSF or to any fund. It is deducted from the 1 million, meaning that the taxman or somebody who's preparing the payroll is going to charge 30% on 950,000. So you're paying less in terms of pay as you earn, but surprisingly, you're getting more as a member of a pension scheme as disposable income. So you're getting more, but again, what goes to these two funds or to the retirement benefit scheme is the same. So this is being used, as I said, in some countries like India, Indonesia, and some countries across Africa to ensure that they increase coverage, they increase participation into pension schemes to the extent that they are saying, look, if you don't save into a pension scheme, you're going to go with 650. But if you save in a pension scheme, you're getting more money in terms of disposable income when it comes to your net pay from your salaries or wages. So that's what I wanted to discuss with you on contributions. But let's first skip the investment and go to the benefit payment. So if you remitting money in the scheme in Uganda, which is recognized by the laws of Uganda, the UBRA Act and the Income Tax Act, as I defined it, a resident retirement fund, then you're not going to pay any tax. So whatever you receive from your trustees or from your pension scheme, as an amount on your member benefit statement, if you leave today, it is what you're going to receive as a payout. This applies to both Ugandans and non-Ugandans. Here I highlighted the dependent because I wanted to put emphasis on who a dependent is when it comes to other relatives who are not spouse and a child. So there is no taxation at the level of benefit payment, regardless of whether a Ugandan or a foreigner. Yeah, so you get your money as it is on your benefit statement. So now I want us to go into the middle phase, which is the investment. And this is where most of the taxation applies when it comes to retirement benefit sector in Uganda. So we adopted, as I said, a E, but I had to put a small t here. But when you look at if we are to be rated by some of those rating companies, they have to come and rate our pension system. The first stage, they will put a T. Why? Because there is no relief. Me, I'm trying to be a good citizen and say you're getting an E on the side of the employer. You're not being taxed, but there is a T on the side of the employee contribution. But when it comes to the rating, those global rating, you'll see that we can't escape a T here because of that. Because the expectation is that you're getting a total relief on the side of the employers and the side of the employee. So here I'm going to discuss investment, but as you saw, our pension schemes, they have invested across the region, not only in Uganda. So for the investments which are in Uganda, the Income Tax Act of Uganda will apply. For the investments which are in Tanzania, in Kenya, in Rwanda, then their respective income tax will also apply. So I want to start with the bonds. As you saw, 79% of our portfolio is in the government securities. And here we have the bonds or the bills which are less than 10 years in terms of maturity. When your scheme is investing, they are going to go into a bond or a government security which has a different tenures. So you find that one is a 3-year, another one is a bill, another one is a 5-year bond, another one is a 10-year. We've seen 15-year bonds, 30-year bonds within the region, 20-year. So tax rates will totally change. But in our country, Uganda, if your scheme has invested money in the bond, which has a tenure of 10 years and above, then if they are paying you a coupon payment or a return, assuming that you invested 1 million in a 10-year or a 15-year government bond, you'll be charged a 10% withholding tax. And this is the final tax as per the Income Tax Act of Uganda. So you're not going to pay any additional tax on these incomes. But when it comes to those which with the tenure below 10 years, 5 years, 3 years, and the bills of different kind of tenures, you're going to pay a 20% in terms of withholding tax. And again, it's a final tax. So if your income is 1 million, or for this kind of securities which are less than 10 years, then you're going to pay 200,000, which is 20%. But when you look at what's happening in other countries, as you noted that you have bonds in Kenya, you have bonds in Tanzania. When you go to Kenya and invest in a bond, they also have different rates for different tenures. And in Kenya, you find that if it is less than 10 years, even bills, you'll be charged 15%, not 20%, meaning that our tax rate on that kind of security in Uganda is higher than what is in Kenya. Then when you go to those which are 10 years, which are 10 years and above, that's when you find a 10%. So it's the same, even in Kenya. But when you go to Tanzania, they are not into 10 years. For them, they are 10 years when it comes to tax laws are different. So you go to Tanzania and you want to invest in a bond, which is 5 years and above. The United Republic of Tanzania decided that those 5 years and above, you don't pay any withholding tax, because I think they have that appreciation that you're investing in our country, and we are making use of the resources within some of these institutional investors. So it is 0%, but if it is less than 5 years, then you go ahead and pay 10%. So you see rates, how they differ across the region. But that does not mean that your trustees or the pension scheme should heavily invest in Kenya or Tanzania, because there are other key aspects which are considered. When you're moving money from Uganda to Tanzania, you're not going to invest in Ugandan shillings when you go to in the United Republic of Tanzania. You have to do some kind of foreign exchange translation. So you may end up being exposed to foreign exchange risk at the end of the day. So the number of things which are being considered. I don't want us after this presentation to go and tell our people, please take all our money in Tanzania in a 5-year bond, because withholding tax is 0%. But let's look at the fixed deposits. If you go into a bank in Uganda, and you fix your money there, whether it's a term deposit, you're going to pay 15% withholding tax. There have been a number of concerns around this area, whether it's a final tax or not. Sure, around 2015, 14, there are a number of documents which we are moving from either URA or from the taxpayers, trying to get some kind of guidance from URA in terms of that. And there is also a withholding tax guideline which was issued by URA, which clearly indicates that withholding tax on fixed deposit is a final tax. But I want you to also go and look at section 117, subsection 1 of our Income Tax Act. In the layman's interpretation, you may think that withholding tax is not a final tax. And because of that, we've also seen that there have been some kind of ambiguity in some of these financial system or sectors, where you find that some players are treating it as a final tax, others are not treating it as a final tax. So we've tried to push this to the Ministry of Finance through our annual proposals in terms of the tax policies for our sector, and hopefully they will look at it, because we see that the guide, it doesn't speak to what is in the law, but for them they are saying they speak the same. Probably since I'm not a lawyer or person who went into a law school, that's why I have these issues. But that's the issue which we are facing there on fixed deposit. But you pay 15% withholding tax on the income which you receive from fixing your money with these banks. But we also have a dividend income, where you're going to pay, where you're going to receive a certain kind of income if you've invested into a listed company or into a stock. So they give you a dividend. And in that dividend, once they are paying a dividend, they are going to withhold 15% from you as a scheme. So they withhold it as a paying institution. So for you as a scheme, you will receive net of that 15% from the dividend. And this is not a final tax, and that's why I'm saying it is creditable under Section 122. So once you pay the 15% and you get either a TCC, then you can use it later, tax clearance certificate. That's what I meant. You're going to use it to claim a certain kind of, to reduce your tax obligation by that same amount. So, but when you look at in other countries, within the region, I think most of them, if you get a dividend from any of those listed companies, the withholding tax is 5%. Again, you can see that ours is 15%, is a bit higher than the rates which are applicable in other countries. So we can also look at the corporate bonds, because corporate bonds, you see that they are also under that Section 117. So when you invest into a corporate bond as a scheme, you're going to pay again a withholding tax of 15% on your earnings. So you will receive net of that. But in Tanzania, if you invest in a corporate bond, they're still going to detain you, because they are thinking that you're supporting these private entities, to grow, to give more employment to the citizen. Then in Tanzania, if a corporate bond is less than 3 years, you will pay a 10%. If it is more than 3 years, you won't pay any tax. So you can see this kind of tax kind of reliefs or exemptions within the region. And the expectation is that the people who invest our money, they can best use of these dynamics or the varying rates across the region. So for the schemes which invest in rental, in real estate, if you have a building as a scheme and you're earning rental income, things changed, I think, in 2023, a tax amendment where URA changed how you should treat, how you should determine your chargeable income when it comes to rental, the rental tax. So now they are saying that if your corporate entity, including the resident retirement benefit scheme, you're going to be allowed up to 50% as a deduction, meaning if I'm earning 1 million on a monthly basis, my annual rental income is 12 million. So 50% of it, which is an equivalent of 6 million, will be deducted from the 12. Then I'll remain with the 6 million, which is going to be charged at a 30% rate. So I'll be paying a 1.8 million to URA when it comes to rental income. And this is totally different from, the treatment of the others. No withholding, no what. You just have to do that. And maybe if I'm to share with you, many people have rentals. So for you, you want to do it like a corporate company. For you, yours is totally different. And for you, you're given a certain allowance. I don't know if it's also 50 or 75%. Then you charge 12. Instead of 30, you're going to be to charge a 12.5%. And you have to pay to URA. Then let's look at the collective investment schemes. In many engagements, I've been asked about taxation of collective investment schemes. And it became prominent, I think, was it last year? Last year, I think there was a certain document or guidance which one of the fund manager in this sector received from URA. So when you look at the Income Tax Act, when it comes to collective investment scheme, the incomes of the collective investment schemes are very, very clear in the, I think, section 21, exempt income. They are saying that collective investment scheme as an entity, yeah, is exempted from tax to the extent of distribution of the income to the participant. I can give an example here. If UAP, collective investment scheme, and I have an income of 1 million, yeah, I'm only not going to pay tax if I distribute the whole 1 million to the participants, which can be retirement benefit scheme, insurance company, banks, individuals, so many others. That's how it is in the law. But it didn't provide guidance on the person who receives the money. If I receive the money from a unit trust as a Cosmas or as a pension scheme, should I also be taxed? Should that income form part of my chargeable income at the end of the year? That's where the ambiguity is. Surprisingly, discussions were there before the 2024 amendments. Some of these issues were included in the bill, in the tax amendment bill, but how they disappeared, I don't know. But they disappeared. When you look at the amendment, nothing is there. But I can confirm that there are more engagements going on between the Minister of Finance, Tax Policy Department, URA, and the Capital Markets Authority, who are the primary regulators of this product, to see what's best for us. But you can see that kind of ambiguity. But the guidance which the sector received from URA is that you should pay a 15% withholding tax. And that's why we've got some entities, they are not, they are taking themselves as a unit trust legal entity, and they are not paying any tax on the unit trust income. Others, they pay 15%. So that area, together with fixed deposit size, a certain area is one of the area. Those are some of the areas which we are engaging those competent authorities to see how we can manage those ambiguities. But we also have other incomes which are exempted. Those who are again familiar with the 2024 amendment, the government introduced another subsection under the exempted income, and it relates to income which some of your schemes can derive from private equity fund or venture capital. So if I invested into a unit, a venture capital or an equity, private equity fund, and they pay me an income, I'm not going to pay any tax. And that's that kind of framing of that section is what we also want for the CIS, such that it's clear that income which is derived from the collective investment scheme is an exempt income. So you find that for private equity fund and venture capital, the government is totally exempting them from the taxation. And we have the yield fund. I think our biggest scheme, the National Social Security Fund, they have invested some good money there. So probably they are going to enjoy and give you maybe better returns or good returns, or a decent return because of those kind of tax exemptions in the Income Tax Act. We also have infrastructure bonds. We don't have them in Uganda, but in Kenya, those who are familiar with the Nairobi FINCA, it was constructed using money after issuing an infrastructure bond. Some of our schemes, our big schemes in Uganda, they invested there some good money. So there it is a 0% withholding tax. And even in our law, the Income Tax Act of Uganda, if one day there is an issuance of the infrastructure bond, it is very clear that no tax should be paid on the incomes from that kind of asset class. So you can see the dynamics around the taxation of these investment incomes within Uganda and within those other countries. So in Uganda, basically for retirement benefits sector, this is where we pay our tax majorly. We pay our tax around investment income. So whatever is being declared to you as a member, if it is a 10%, if it is a 5%, if it is a 1%, just to know that you've already paid your tax and it's going to be credited onto your individual account. And the day when you're leaving, you're going to get your contributions and the interest which they have been declaring, because it is declared after taking into considerations all these taxes. So I want to share with you what's happening elsewhere. And there are a number of interesting things here. As I told you, you may see a EET for a certain sector, but when you go deep into analysis, you realize that, well, there are many other tax regimes within the same sector. So I will start with, let me start with the Republic of Kenya, where when you go and if you Google today, you'll find the EET, isn't it? And I think in the recent, the tax bill, which didn't pass because of, what happened. When I saw the presentation from the PS, I don't know if the PS or the Minister of the National Treasury, he was proposing more reforms in the pension sector, but they were specifically around the taxation, where they were proposing an increase in the tax relief from 200,000 Kenya shillings to 300 as a tax relief on contribution. In Kenya, this is what happens. They have a limit when it comes to a tax relief they can give you into the contribution. If you're in Kenya and you want to make a contribution into a pension scheme, and I'm looking at both the employer and the employee, if it is below to 20,000, you're going to get a relief up to that extent. What I mean is that if, for example, you're earning 100, so they are going to remove if the 20,000, 10 is coming from the employee, they are going to remove the 10,000 from your 100. So your pay as you earn will be charged on 90,000. So they wanted to increase that to 30,000, but because of what happened, it didn't turn into a law, so they are still using this. So assuming you're making or your total contribution in Kenya is 50,000 into a pension scheme, you're going to see that only up to 20,000 is going to be exempted at the beginning. So the difference between what you're contributing, from yourself and the employer, from yourself, it won't get a tax relief. So it won't be deducted from your total employment income when they are determining pay as you earn. At the same time, what you receive from the employer, again, it won't be exempted from tax. That's why I'm saying that for those who contribute, whose contributions are within the relief, they totally benefit, or they will be under this regime. All the monies which are not within this limit, they will go into another tax arrangement, which is likely to be a TTE. So you're being taxed somehow at the beginning. The investment incomes which are generated are also taxed. But at the end, the benefits are only taxed if you as an individual under the age of 35. And if you're above 35, yeah, you're going to get and you're receiving below this. Again, you're going to benefit from, I'll say, another tax regime of a triple EE, whereby you're not going to be taxed anywhere. But all the monies which fall into this other kind of regime, beyond the 20,000, they will be exempted because you've already paid tax here and here. So you find that in some countries, they are running some other tax regimes just to provide some kind of control, because I just assume you allow 100% here on E to give you a tax regime. Personally, if I'm earning 2 million, I'll say the whole of my 2 million should go to NSSF. If it goes to NSSF, I won't pay any tax here. But there are other things which the government is interested in terms of tax revenues, you know, the government expenditure. So government won't have money. That's why wherever you see a EET, there are some controls on how much you should contribute to the scheme, or they provide some kind of limits on how far you can go in terms of contribution. So that's the Republic of Kenya. And as I said, if you're 65 years and you've been under this arrangement, you're going to enjoy, you won't even be taxed here for the monies or the contributions you made within this limit. So I also want to look at the Republic of Rwanda, which totally has a different tax regime. For them, they tax at the beginning. And taxing at the beginning, I'm basically saying that they tax at the stage of contribution. Investment income is not taxed and benefits are not taxed. But this is what happened. In Rwanda, you can go up to 3% contribution as an employee. Yeah. So you go up to 3% as an employee in terms of contributing to a social security scheme or a retirement benefit scheme. And when it comes to computing, again, your employment income, you see that they are removing the 3% contribution, which you've made to a social security scheme before they determine pay as you earn. You get? But when it comes to the employer contribution, the 10% which you receive from your respective employers, it is added to the employment income. Meaning, if I'm earning 1 million and the employer is making another 10%, they are going to add another 100,000 to form part of my employment income, and it will be charged at the applicable rate. You see these dynamics. So in Rwanda, where we have the T, the employees get a relief on their contribution, but the employer contributions, they are no relief. So in some other countries where they have a T, you will find that they are giving a relief here and they're also giving a relief here. So it depends on the minds of the framers of this law and what they indeed want to achieve is what informs or what we are discussing here in terms of the different aspects of which regime, which controls should we put in place. Let me also look at the United Republic of Burundi. The United Republic of Burundi, they give a tax relief on contribution up to these francs, Burundi francs of 450,000. That's equivalent to around 600 Uganda shillings. So you get a relief up to that. And in the Burundi, all the monies which are beyond the 600 Uganda shillings, they are taxed. Or you cannot deduct them from your employment income to determine pay as you earn. So they go into another kind of tax regime. But if you're within the 450, you'll get a relief here, yeah? And when it comes to taxation under this regime, you see that the investment in government bonds are not subject to tax. So you scheme and you invest in a government bond in Burundi, you're not going to pay any withholding tax and not any other tax you pay. So all the incomes will accrue to you. It is a different story if you're a non-resident. If you're from Uganda and you've taken your money in Burundi, you won't get this kind of relief. So the rate is, there is a certain rate. You can't guarantee earn from their country and you don't contribute to the development of that country. So you should earn a return and there is an applicable rate for you. This applies to the residents only. So other investments in Burundi attract a 15% fixed deposits. I think when you look at the pension sector of Burundi, most of the money is within fixed deposits in banks. And because there are few bonds being issued by the government. So you find that there is a T in the middle because of this, because of that one aspect of the 15% on other investment. But when it comes to the benefits, if you're within the 450,000, then you will be exempted. But if your money beyond the 450 will go under this kind of regime, and for them, the difference between them and Kenya is that for them, they are very limited the T on the side of investment. So you will get an exemption, they will be taxed here, but not any other tax. It will earn a return, not taxed. So it will be part of your benefit at the end of the day. So that's what's happening in Burundi, Kenya, and Rwanda. I can also speak to our good neighbors, the United Republic of Tanzania, of course, together with the Zimbabwe, because most of the laws apply in those two states. So you see that the contributions are capped at 20%. Contributions are capped at 20%, both from the employer and the employee. So to make a contribution in Tanzania, one don't even give you a leeway to go beyond the 20%. So you can only receive a 10 from yourself and from the employer, their DB and the DC arrangements. So you find that they are capped, and if probably you're thinking of saving more, you have to go into other arrangements which are totally different from retirement benefit schemes and you're taxed there. But that is how it is in Uganda, but different tax policies apply on the investment incomes here for the residents there in Tanzania. So you see that they also have a T, but they do have a total tax relief here on the side of contributions. Uganda, I've explained, I don't have to repeat myself, but I want to share with you what's happening in Tanzania, in Nigeria and South Africa. Before 2010, South Africa had a different tax regime. It was a comprehensive one. It was ETT. You could get exemptions on the contribution, pay tax on the investment income, and pay tax at the benefit payment. So around 2012 or 13, there were some changes there where they adopted a EET as an expenditure or a consumption tax system for their pensions sector. And again, they're also giving a relief up to 27%, yeah, and capped. You see now there is a relief of 27%. If you're to contribute into a social security scheme, you cannot go beyond 27.5% of your earnings, yeah? And if the 27% of your earning is beyond the 350,000, then you're going into another regime, yeah? So which is likely to be a tax at the beginning and a tax, and either they can decide to tax in the middle and you get an exemption at the end. So, but it is capped at 350,000. So if you're within that cap in terms of contribution, then you're going to enjoy the EET. With the new reforms, the current developments in South Africa this year, around June, May, there is an introduction of a two-pot system. One relating to retirement, and another one is for short-term saving. So I can give an example. If you're contributing 100,000 into a pension scheme in South Africa, 2/3, which is 75%, will go towards your long-term account, and a third will go towards the savings pot. For short-term purpose, you can access it anytime. But what they did is to introduce some kind of taxes. If you're into a retirement, your money is into a retirement pot, you can only access it at retirement, unless it may be your dead and the dependents access it. But when it comes to the savings pot, you can access it anytime. But what is happening is the tax rate for the retirement pot, yeah, is significantly lower than the one of the savings pot. Why? For them, they are saying the objective of this retirement system for our country was for old age poverty. Why accessing it now? Well, we've given you some leeway to, to benefit from the short-term pot by getting money, paying school fees, and so on. But there you're going to pay a lot of tax because you've been benefiting here and here in terms of getting tax exemptions as a retirement kind of arrangement. Now you're accessing it. It's no longer retirement, so you pay a higher tax rate. For the retirement pot, the whatever the tax rate is totally lower, and it depends on the income tax band which are there. And you find that in most of these countries which have adopted a EET or a kind of an expenditure tax system, you don't get a lump sum at the end. You're likely to get a pension, which pension is going to be taxed as per the tax band of the personal income tax of those respective countries. But in countries where we've seen that they are taxing at the benefit payment, you're likely to see that those are the countries majorly paying out, taxing in the middle. You see that those are countries majorly doing what, paying out lump sum. You see majority, but not all. But let's also see what's happening in Nigeria. When you're in Nigeria and most of the countries around the West Africa, you see that they have adopted the EET kind of a tax regime for their pension system, and where they are giving a tax relief on employee contributions. Nigeria, I think 5 years ago, these contributions which could get tax relief, it was only employee contributions, which are mandatory ones. But they introduced the AVC, the additional voluntary contribution, that if again you make a voluntary contribution, again you will get a tax relief. And employer contributions are not taxed. This is something which is very interesting because you're looking at where the controls within their system in terms of taking care of the interest of the tax revenues. But again, when you make a AVC, you can only access it twice in 2 years. And once you access it twice in 2 years, you have to pay a certain kind of tax to the members. So ladies and gentlemen, these are the comparison across the region, and that's how our retirement system is taxed. Uganda has a tax system which is the ETE, and there is a number of questions which arise whether it is the best or not. But I've told you that when you look at the literature and even the study which was conducted by the Minister of Finance, I think 2 years ago, they indeed indicated that we need to move away from an ETE and go to an expenditure approach. The question which we need to consider or to look into is, what are those controls within this system? What are those silent features of EET? As I've showed you, you can have a EET and another country with also EET, but those silent features are very critical in terms of the limits they put, yeah, Because today you can contribute any amount. You can get any amount from your employer and you don't pay any tax. If you receive money from your employer, the 10%, you go to a voluntary scheme, you get another 20%, that's 30% of your monthly payment. It goes into a scheme, not taxed. At investment, the returns are the only taxed. At the end of the day, you're getting your benefits, same amount, not taxed. So you see, as we are speaking about, reforming our pension systems, the number of things which we need to consider when it comes to taxation. So these guys went ahead and say, no, we can't go into it because the Constitution already says pension is exempted. So because of that, they proposed a TEE, but they didn't go further to provide some of those key considerations when it comes to taxing T. Are you going to tax the employer contribution, or you're only taxing, or you're only giving, not giving a relief to the employee contribution? So those are things which you have to think about when such discussions are, they are with us, such that we can determine the best system for these sectors. But of course, there are also a number of questions around other packages, the retrenchment, the termination, and so on. But the way pension is taxed, or retirement systems are taxed, are totally different from how things like retrenchment packages or terminal benefits are taxed, things like a gratuity. So if indeed you want the gratuity, the retrenchment, then different rates will apply. And I'm sure you had a number of court cases about retrenchment where the courts have said, if you're retrenched and you get a package, it must be taxed as per the Income Tax Act of Uganda. Same applies to gratuity. What matters is when you receive it. If you want to receive, if you're paying gratuity on the annual basis, then that may cease to be under a certain section, which gives yes 75% as a relief on the amount which you've received, because those who can benefit from that is that you've worked for an institution for more than 10 years. So if you're getting your terminal benefit and you've been within an institution up to 10 years, then you get a 75% of as a relief, then the balance is what they tax. But if you're getting the annual gratuity, then you cease to go into other kind of tax regime. For the long service awards, I think it was a good discussion in Uganda. I don't know whether it was taxed or not. That one, I don't have any idea. But over to you, Mr. Benjamin.
Thank you so much, Cosmas, for the discussion. I'd like to say that you've done well to articulate the issues that relate to our sector. But of course, the question of whether it should be a consumption or income tax treatment is something that you touched at the beginning, because you will notice that most of the countries that adopt the income tax treatment are those countries that are looking to mobilize revenue. So I noted from your presentation that, for instance, if we look at treasury bills and bonds, there's a checkpoint for withholding tax. When you go to corporate bonds, there's a checkpoint on the capital gains that are earned on early sale and through an original issue discount. Then when you go to the dividends, still we have withholding tax, which is paid. Then the rental income. So clearly, the indication or what we draw from our current treatment is that we are looking as a country to draw revenue to finance public expenditure. So it takes us to the question, what is our policy on retirement saving or for the retirement benefit sector? Some of the countries you've touched, like South Africa, clearly you see that they're making entry points to see how they respond to the issue of old age security. And that's why you see a movement from a consumption tax, from an income tax treatment to a consumption tax treatment. So ideally, the countries that are doing well at responding to retirement security are either taxing once at the point of contribution or wait and then they tax at the time of paying benefits. So this helps then to make sure that members' savings are able to grow over time. And you can see from our numbers over time that what drives growth of assets of this sector, for the most part, has been over the last 10 years, has been investment earnings, notwithstanding the constraints of market. We see that investment earnings outweigh the contributions that come in. So clearly, our system as it is responsive to our need to mobilize domestic revenue, and the proposals that we seek to provide are those that are responsive in suggesting that we must look at the future retirees if we are to deal with the contingencies of old age. I thank you so much once again, Cosmas. And when you mentioned South Africa, you mentioned briefly about the domestic savings vis-a-vis retirement. The countries that adopt the EET approach or the TEE, that is where they're looking at the consumption as opposed to income. Clearly, when you look at their numbers, you see that they go on to increase their domestic savings in the long run, mainly driven by the retirement benefit sector. The evidence is that as you grow the domestic capital supply, you realize it exceeds the domestic capital demand. So you can see that even when we are looking at pushing the national development agenda, in the long run, if we adopt the consumption treatment, it's better for us as a country. But this comes under the backdrop of the much needed resources now to drive the national development agenda. So it's time for questions, and I can see a number of questions have come through. I can see, Cosmas, I would like you to respond to the issue of multiple taxation with regard to the unit trust, because there's a question about a payee and income tax, and why should we pay tax when withdrawing the unit trust? Isn't it an aspect of multiple taxation? So I would like you to touch on the issue of when you look at the transmission channel, when we reach the point of withdrawing from the unit trust, what happens? And tie it together with the income treatment that we have at the moment, and then you highlight that to Herbert Amola. Also touch,
thank you.
Cosmas, can you hear me?
Yes, you are breaking. Hope,
yes, I said.
Hope you can hear me.
Yes, I can hear you. Please touch on the issue of multiple taxation.
Okay.
For now, and thereafter we shall look at the innovations that we can have to mobilize the informal sector workers in as far as incentivizing them to save for retirement. And then later we shall touch on the issue of voluntary savings. Please go ahead.
Okay, thank you, Benjamin. And I think, Herbert, thank you. It is indeed a good question. When I remember the discussions when they introduced that tax bill in Parliament, it was around the citizen, those who are interested in the subject matter. Some of them were saying that there is a double taxation. But when you look at taxation, we should first appreciate whether they are paying the capital which you've injected into an investment, or they are paying the incomes which the capital has generated. I get my money today from my employer, yeah, and probably I get my 2 million. I decided to place 1 to a unit trust. So when I'm going to the unit trust, what I'm taking is in terms of capital. And when it comes to exiting that unit trust, they are not going to tax that capital, the 1 million I saved there. They are going to tax the income which it has generated. Yeah, that's how it is. It's like how I get my money. I fix it with the bank to get, to fix it with the bank, a term deposit. So if I put there 100 million and it's a 10%, I'll get my 10% after deducting the 15%, you see. So we can look at it in those same line. But what we need to do is to say, guys, if we indeed want to promote the CIS or these other saving vehicles, what can we do as a country? If we are giving exemptions to the private equity fund as it is, as per the new amendment, that whoever has invested the money there is going to be exempted from tax in terms of when he's receiving income. Why is it not on the side of collective investment schemes? Of course, probably the policymakers might be looking at people bringing capital in Uganda in terms of those private equity funds. Yeah, but as we are giving this kind of incentives to such arrangement, yeah, because once you give that kind of arrangement an incentive, you're basically attracting citizens to go into it and invest. Why don't we give the same to the collective investment scheme and say, well, for the members who put your money there, once you're getting a return, you're also going to be exempted. And I think we also had a discussion some time back where we are saying, is the focus of government on short term or long term? And which is better to the government? If you're giving SACCOs tax holiday up to 2027, it was a 10-year thing, 10-year tenure exemption. These are short-term vehicles, and you don't have any guarantee that you're going to utilize the money as government. Yeah, but you're saying these are the arrangements which are long-term. They are no tax holidays. So what do we want as a country? To promote short-term savings, and how are we benefiting? Or to ensure that we promote long-term savings? With the long-term savings, if you can do that, even the cost of borrowing on the side of government is going to reduce. You saw how much we have to pay in terms of the interest cost, which may even be 30% of our national budget. I'm not so sure about the figures, but it's a huge. Probably we are going out to get external resources at a higher interest cost. Why don't we ensure that we have a favorable environment to ensure that these unit trust, pension scheme, institutional investor can mobilize members, bring them on board. We have enough which we can borrow as a country, and we reduce on the interest cost, because once you have a lot on domestically, then when it comes to pricing, the competitiveness, it will also be totally different. You're not likely to pay a lot. Then you also mentioned about informal sector, and I think Mr. Mudu, later here you're going to come in on this, because there is a number of studies and engagements which you're spearheading when it comes to this. But in countries which have indeed tried to succeed when it comes to informal sector, there are a number of things which must be in place. And I want to speak on tax incentives. Those must be there. If you want to bring the informal sector on board, you must have some incentives. They can be tax or other monetary incentives. In Rwanda, there is a matching. If you're in the informal sector and you contribute, of course, there are some eligibility. Not everybody in the informal sector will get a government matching. So those are things which probably need to be considered if we are introduce such in Uganda, because even customers will be as a member of the informal sector and is getting a matching if it is just open. So incentives are very critical, but we've seen that tax incentives play a critical role for the informal sector enrollment into this arrangement. Chair, over to you.
Thank you, Cosmas. Just to say that when we mentioned about the income tax treatment, you will notice that the definition of saving at that point of income tax is abstinence from consumption out of disposable income. So whenever we're talking about saving, we must add that saving and investing for retirement, such that probably the tax treatment can change. But if it is merely saving, when the purpose for saving, say in unit trust, is not well articulated, then the taxman does not understand all the monies that are saved or invested just merely as putting aside money, outside the disposable income, then the tax treatment applies. But I can see Mr. Fred Nyaika, his hand is up. Please go ahead with your question.
Sorry, mine, I think it is by error.
All right, so I can see, Cosmas, we have just a few more questions before we close. The issue of the contestation that retirement benefit schemes should pay income tax on the surplus for the year. What do you say about it? And then there's an issue with regard to whether or not we should move to farming and agriculture as a safe zone, since there are exemptions to farming, especially inputs and imports that relate to agriculture. So probably how would schemes go into that zone, and is it something that can make a profitable mandate for schemes? Cosmas, please go ahead.
Okay, thank you, and thank you, Amon, for asking this. I think I didn't mention about the 30% corporate tax. In the Income Tax Act, we have a third schedule which talks about stipulated 30% for the trustees and I think retirement funds in terms of the corporate tax. So what happens is all the incomes where withholding tax is not fine, you have to pay an extra 15% because the cap is 30%. For example, if you pay 15% on the bond, on the dividend income as withholding tax, you're going, when you're computing your corporate tax, because it's not a final tax, you see that you're going to, one, remove the 15% which you've paid, from the incomes of the year, but also you're going to incur another 15% to make it 30% in terms of the tax to URA. There are other investments which I have not talked about. For example, if you've sold a certain instrument and you've earned a gain, remember for the bonds we've been talking about, coupons, interest income, but there's also selling and you have a gain. But the law, again, clearly provided guidance in 2025 amendment that all the gains on the disposal on government securities, you're not going to pay tax. But let's look into the equities and what, and you indeed earn the gain on the disposal. There, the 30% will come in. But my view in all of this is probably all that which is being done may not be something which is bad because of the different agenda of government. But we just need to appreciate the primary purpose of some of these arrangements, such that we can provide tax policies which are indeed favorable or which supports these systems in terms of development, such that all of us, we can benefit as the citizens of Uganda.
Thank you, Cosmas. And lastly, Cosmas, there is a question about dependents, where you highlighted the one's spouse or civil partner, children below 18, even those that are adopted, and a person that is financially dependent on the deceased. Hajat Sibiala says that she thought that once you nominate somebody, then that person is paid. What is your take on that?
Okay. Indeed, when you nominate, the expectation is that I nominated somebody and now I've gone to heaven to rest. So the trustees should be able to pay the person. But as trustees are thinking about paying, we have clear laws and we have the Income Tax Act. And it was clear when they talked about dependents to the extent that they say a dependent in relation to a member of a retirement benefit scheme, yeah, can be any relative of a member who the commissioner is satisfied relies on the member for support. You get the child, my children, my spouse will be eligible. There we don't have any question. The question is on those other dependents which are not within the definition of a spouse and the definition of a child. I gave an example. If I just put my auntie, my uncle, yeah, the trustees should be able to prove that those people which have listed there and they want to pay them, they have been relying on me for support. Yeah, that's why in some countries there are special circumstances where if my spouse dies, God forbid, and I've been listed there as a dependent, and I do have a pension account also, I won't be entitled to the 100% of that money. I'll be taxed. If there is an individual who is listed as a dependent, yeah, and that individual is not financially well as per the set standard, you're likely to see that some of those people will be taxed a lot of money. So tax policies, they keep on differing and they keep on changing depending on the economic factors and the number of factors. So as a dependent, if you're well off in some countries, you may not get 100%. But if, for the child, you're likely to see that they may even be exempted from tax as it is on our side. But in some countries where even dependents pay tax, there are some special circumstances that if this one is a child going, a kid probably totally exempted from tax.
Okay, thank you, Cosmas. I know the issue of dependence is subject of some complaints as well. And I don't know, Doris, can you hear us? I would like Doris to comment based on the experience we've had on these issues as they relate to dependence. Doris, if you're there, please go ahead.
Yes, Benjamin, kindly repeat
yes,
that question.
The issue of dependence, of dependence, who is a dependent, especially with circumstances where you go beyond children and spouses.
Okay, there are several contexts in regard to dependence here. You'll find dependents are mentioned in the Succession Act, as well as the Land Act. So you'll find there's quite a number, but the general, for instance, in the Succession Act, a dependent is considered to be someone who is depending financially, is being financially supported by the deceased person. That is in the context of the Succession Act. And that usually tends to be the interpretation that is taken on in majority of the different contexts, say land and let's say in terms of maybe tax. I would believe you may find that context of financial dependency, or there is support, financial support being given to this person by the individual. Maybe in case of succession, we'll have it as the individual who has passed on. So the owner of the deceased estate will consider that person who has been receiving financial support. So whether it's your mother, your aunt, if they can prove that they've been receiving support for some form of economic support from this deceased person, then you consider this person a dependent of that deceased. So I would like to believe that that kind of interpretation is what cuts across even in regard to taxation. Yeah, thank you, Benjamin. Over to you, Benjamin.
Thank you so much, Doris. I know Mr. Fred Nyaika has been at this business for quite some time. Mr. Fred Nyaika, as we close this meeting, I would like you to comment on the issue of tax treatment in Uganda. Fred, are you on? Okay. I think Fred has exited. Distinguished participants, would like to thank you so much for really giving time to this important webinar, as it helps us to do better as members and as trustees, as service providers. We believe that these kinds of engagement allow us to share and draw upon experiences from a broad spectrum of practitioners and members. And this is the only way we can really frame our minds about what it is we must do to drive the retirement benefit sector in Uganda. At UBRA, we are looking at members. So a member-based perspective is what can help us to make sure that the tax treatment is responsive to what we expect the member to get in the end. So adequacy is very important. And if we look at a member-based perspective, then we are able to manage and deal with all the contingencies of all age. I've seen lastly a comment from Fred Nyaika about the nomination, where he says, in addition, the nomination is deemed as a letter of wish. The law mandates the trustees to take care of all dependents. This, in most cases, works for members as they may not have remembered or updated nominations. So once again, I would like to thank you so much that have been part of this. We are looking forward to further engagements in the future, especially the one that is upcoming next week, which will focus on member rights and obligations. Thank you so much, and this webinar is closed. Have a great afternoon. Colleague members have been reminded about the post poll for the webinar. Please take a moment to complete the poll, those who can, such that it helps us to understand how best we can organize these webinars in the future, and what topics we should embed in further discussions. Thank you so much.